If you haven't figured out what game you're actually playing, the market will never give you the outcome you want. This is one of the most overlooked questions in investing. Yet it is the very first one that should be answered. Most people throw their attention at price movements, industry stories, trends, news, opportunities, but almost none of them ask, what game am I really participating in? The importance of this question usually doesn't surface until years later, after fatigue, frustration, and repeating the same mistakes finally force people to face it. By the time they understand, they've already taken a long detour. I first realized this on an ordinary afternoon in Omaha. Buffett and I were sitting in the same small diner we'd visited for years. He wasn't talking about stocks, wasn't talking about the market, and said nothing about investment techniques. He simply stared at an old point of sale machine next to the cashier. After a long while, he pointed to the machine and said, "See that? Its rhythm doesn't get disrupted by the noise outside. Anything that survives time tends to look like this." In that moment, I understood. He wasn't looking at the machine. He was looking at the structure beneath it. A structure untouched by noise. A structure that survives seasons, cycles, and chaos. Most people in the market keep their eyes on the short term. A few keep their eyes on this kind of underlying structure. Because they're looking at different things, they end up playing completely different games. You think you lost to the market, but from the very beginning, you were simply playing the wrong game. You're not confronting the market. You're confronting the rules. When you slow down and truly observe the market, you'll notice something simple, yet ignored by almost everyone. Everyone participates in the market, but very few realize they are actually playing two entirely different games. On the surface, these games look the same. People buy stocks, study companies, care about returns. But underneath, the logic, rhythm, goals, and methods belong to two opposite systems. One is the fast money game. The other is the time game. The difference between them isn't technique. It's the underlying rules. Understanding this distinction is the real threshold to entering the core of investing. The first game is the fast money game. In this game, the most important thing is price. Price movements, market emotions, breaking news, and other people's actions form the basis of most decisions. Players focus on how does it look today? Where will it go tomorrow? What is everyone else doing? The faster they move, the safer they feel. The more excitement they chase, the more involved they feel. The more frequently they act, the more they believe they're in control. But the essence of the fast money game is reaction. Reacting to news, reacting to swings, reacting to behavior, reacting to emotion. This game naturally relies on speed and naturally consumes mental energy. It creates short bursts of excitement, but rarely produces stable long-term outcomes. The second game is the time game. In the time game, the core is not price, the core is the business. Players care not about today, but about the future. Not about noise, but about structure. Not about fluctuations, but about continuity. Their questions are different. Will this company be stronger 10 years from now? Are customers deeply attached to it? Is its cash flow stable? Does the competitive landscape support it? Can its value survive through time? The essence of the time game is not reaction. It is judgment. Judging the nature of the business. Judging the direction of the industry. Judging long-term certainty. This game doesn't depend on speed or frequent moves. It requires understanding, patience, stability, execution, and once the direction is correct, time delivers the rest. The difference between the two games exists from day one. But most people only realize this after many years of frustration. The fast money game runs on short-term rhythm. The time game runs on long-term rhythm. The fast money game depends on daily outcomes. The time game depends on decade-long outcomes. The fast money game forces endless decisions. The time game requires only a few decisive ones. The fast money game is driven by speed. The time game is driven by direction. Both are called investing. But in essence, they are two entirely different life paths. The real question isn't which game is better, but which game aligns with your goals, temperament, patience, and natural pace. People feel exhausted in the market, not because they lack intelligence or because their methods are wrong, but because they unknowingly step into a game that does not match who they are. A game that creates anxiety from the very first day. If you cannot distinguish between the two games, market volatility will push you in a different direction every day. But once you see the distinction clearly, you'll realize the market isn't complicated. What's complicated is the game you choose to play. Real investing never begins with picking stocks. It begins with choosing the rules of the game. If you look closely, you'll notice something ironic. Almost no one chooses the fast money game. Yet almost everyone gets pushed into it. Not because they're greedy, but because the structure of the modern world is designed to make you move fast. You didn't choose the game. The world chose it for you. When I was younger, I didn't understand this. I thought speed was human nature, that everyone naturally wanted excitement, short-term results, and quick wins. It took me years to realize this isn't human nature at all. It's the rhythm modern society imposes on us. And this rhythm has four forces behind it. As long as you live in today's world, you can't escape them. Let me break them down one by one. Once you see them clearly, you'll understand why most people never even get the chance to start with the right game. The first force is the lure of instant feedback. Human beings have an almost uncontrollable desire to see results immediately. If someone doesn't reply to your message in 3 seconds, you wonder why. If a short video gets no likes in 5 minutes, you begin to question yourself. If an investment remains still for half a day, you feel uneasy. The market understands this better than anyone. So it offers the perfect temptation. A price that changes every second. A small rise makes you feel smart. A small dip makes you feel you should act. The bigger the fluctuation, the stronger the illusion that you must do something. The market trains you into a creature with reflexes tied to red and green lights. The faster you react, the more control you think you have. But what's actually being controlled is your attention. The second force is social pressure. It's hard to stay calm when you constantly see others making money. You start to feel slow, behind, or left out. In an era where information spreads faster than emotion, your phone becomes a showcase of other people's gains. A stock hitting its limit, up a coin, doubling overnight. A friend earning a month's salary in 2 days. The more you see, the more you believe. I can't afford to wait. And without noticing, you switch strategies. Not to be right, but to avoid falling behind. Charlie once told me, humans can't stand the idea of others running ahead of them. The younger they are, the harder it is. The issue isn't greed. It's the fear of being left behind. And that fear pushes people into the most unstable rhythm possible. The third force is the anxiety of proving yourself. Many people don't start investing to make money. They do it to prove they haven't made the wrong life choices. And the younger they are, the stronger this urge becomes. They don't crave profit. They crave validation. And the market offers validation faster than any industry in the world. Every minute, it tells you whether you are right or wrong. But price movements are not answers. They're noise. The human brain, however, confuses instant reaction with real progress. The more someone wants to prove themselves, the faster they get pulled into the fast money rhythm. I once asked a young analyst, "Why are you in such a hurry?" He told me a sentence I'll never forget. "I'm afraid that if I slow down, I'll realize I'm not talented." That's the third force. It exploits the most fragile part of human psychology. The fourth force is information noise. The amount of information in investing is enough to drown anyone. Every day brings new concepts, new industries, new headlines, new data, new opinions. The more you try to understand, the less you actually see. Because information doesn't help you decide. It pushes you into deciding. One headline makes you react. One analysis makes you reconsider. One rumor makes you adjust. Someone else moving makes you want to follow. By the end of the day, you haven't invested, you've reacted. And the more you react, the more mistakes you make. More mistakes lead to more fear. More fear leads to more speed. And more speed keeps you trapped in the fast money game. There's an old saying in the East, when the mind is restless, judgment collapses. And the fast money game feeds on exactly that. Keeping your mind in a constant state of restlessness. Why do 99% of people get swept into this game the moment they step into the market? Not because they don't understand long-term thinking, but because every corner of this era pushes them towards speed, from social platforms to news feeds, from friends' stories to tales of overnight success. Everything is designed to accelerate you into a game you never prepared for. You think you're making choices, but most of the time, you're simply being carried along. The deeper you live in this era, the harder it becomes to slow down. Slowness looks like incompetence. Patience looks like falling behind. But the truth is the opposite. In the world of investing, the more anxious everyone else becomes. The more those who slow down eventually pull ahead. The market does not reward the clever. It rewards the ones who refuse to be rushed. At first glance, the time game sounds like a slogan. But it isn't. It is a clear, structured, and deeply logical framework for investing. If the fast money game runs on emotion, the time game runs on three things: structure, rhythm, and continuity. To understand the time game, the most critical idea is this: time is not a background element. In this game, time is a participant, a partner. If you stand on the right side of it, time will do things for you that you could never do on your own. And the time game has only three fundamental rules. Internalize them, apply them, and your trajectory in the investing world will change. The first rule: value comes from continuity, not speed. Most people believe companies that rise quickly are better, and people who move fast are more capable. But anything that truly lasts through time rarely grows through moments of speed. It grows through something far simpler: continuity in earnings, continuity in growth, continuity in customer reliance, continuity in competitive strength. On the board of the time game, no single explosive year decides the outcome. What decides? It is how many years the business can keep compounding. Some companies shine for a year and fall behind the next. Others grow only a little, but they grow a little every year, for 20 years. Real compounding lives in the second group. Charlie once said, "A decent business, sustained over time, outperforms a brilliant business that cannot sustain itself." Speed deceives you. Continuity doesn't. The question isn't, how much can it rise next month? But can it still earn money this naturally 10 years from now? Time blossoms for continuity. It never cheers for speed. The second rule, compounding is time's reward, not your skill. People talk about compounding constantly, yet most misunderstand its essence. Compounding isn't about what you do, it's about what you don't do. It's not created by frequent decisions. It's protected by avoiding interruptions. Compounding isn't addition, it's multiplication that only works when you stop breaking the sequence. In other words, successful compounding comes from the ability to avoid destructive mistakes, not from doing more right things. You may do 3 things right in a year, but one big mistake can erase all 3. Masters of the time game do the opposite. Instead of trying to do more, they try to destroy less. Why does Buffett appear to do nothing for long periods? Because preventing damage to compounding is far more important than chasing additional growth. There is an old saying in the East, "What you can hold steady, you can keep strong." In this context, it means that real compounding doesn't come from doing more, but from preserving what you've already done right by not breaking it. If you can go 10 years without making a catastrophic error, time will push your assets to a level others cannot imagine. The third rule, direction matters more than effort, and effort matters more than frequency. In the time game, one rule stands above all. One correct choice is worth more than 10 correct actions. This logic is the exact opposite of the fast money game. Fast money players believe attention and activity create returns. Time game players know that only key decisions determine the future. The companies you choose decide whether time will help you. The kind of business you choose decides whether you'll sleep well in 10 years. The rhythm you choose decides whether you'll be dragged by the world or walk at your own pace. Once you choose correctly, time walks the rest of the journey for you. You don't need to run fast. You only need to stay on the right track. The power of direction is greater than the power of 1,000 individual actions. This is why masters of the time game never rush to make progress. They spend more time choosing the right industry, the right company, the right structure, and then do only one thing, protect it from being ruined. The final outcome is simple. Fast money players move every day, yet go nowhere. Time game players move occasionally, yet go far. These 3 rules form the foundation of the time game. They don't sound exciting or dramatic, and they don't provide the instant gratification that short-term predictions offer. But they are the rules that survive in the real world. Markets change, people change, industries change, emotions change. Only these 3 rules never change. There is a phenomenon in the market that becomes impossible to ignore if you observe long enough. A pattern so stable it feels like a law of nature. The same great company, bought at the same price, with the same understanding of the industry, and even the same starting point in holding period. Years later, one group sees tenfold or 20-fold gains, while another group walks away with only a few percent. They were doing almost the same things, yet the outcomes could not be more different. This isn't luck. It isn't technical skill either. It comes from the most overlooked, yet most decisive factor in investing. Behavior. The same company in different hands becomes a completely different investment. And this is where the gap between the fast money game and the time game first reveals itself clearly. Time game players focus on holding. Fast money players focus on reacting. Even if both start on the same day with the same stock, human nature will pull them further and further apart. The first difference. Fast money players want to be right now. Time game players want to be right later. When most people buy a good company, they rarely ask the critical question, what if it doesn't move for a while? Can I live with that? Will they start doubting? Will they get anxious? Will they chase another idea just because this one isn't exciting? Will they let short-term volatility shake their long-term logic? Fast money players obsess over the first 3 months after buying. They want immediate confirmation. So any sideways movement, any correction, any rumor is enough to shake their conviction. The more urgently they want to prove they're right. The faster short-term waves knock them out. Time game players think in decades. They know short-term fluctuations mean almost nothing. They don't judge the investment by immediate price response, but by whether the business remains solid. That's why the same company is sold by one person in 3 months and held by another for 10 years, turning into a life-changing 10-bagger. The second difference. Fast money players seek a sense of action. Time game players seek a lack of damage. The fast money game creates an illusion. If I'm not doing something, I'm not in control. So they add on a small rise, cut on a small dip, switch to the next hot stock when others brag about gains. Their mind lives in a constant state of readiness to react. This state becomes intoxicating, always generating the urge to do something. But the real danger isn't moving too little. It's breaking compounding. The biggest enemy of compounding isn't loss. It's interruption. Every sell and buy back, every switch from one idea to another. Every reflexive reaction fractures long-term outcomes into pieces. Time game players seem boring in comparison. Fewer actions, fewer decisions, fewer trades. But that boredom is the environment compounding loves most. They aren't driven by impulse or the need to prove anything. They understand a simple truth. Every unnecessary action dilutes future returns. The third difference. Fast money players hold with emotion. Time game players hold with understanding. Holding a stock for 25 or 10 years isn't about courage. It's about comprehension. You must understand why the business is good, how its model works, why its customers stick, and why it can survive cycles. Fast money players have only one reason to hold: price. If it rises, they think it's good. If it falls, they think it's bad. Such reasoning collapses under the smallest volatility. Their emotions break long before the business does. Time game players hold for a completely different reason. The business itself. They own the cash flow, the customer habits, the long-term demand, the structural durability. As long as these remain intact, temporary price noise cannot force them into decisions that destroy long-term returns. People who truly achieve tenfold or 20-fold gains don't have stronger hearts. They have deeper understanding. Understanding holds things together. Emotion doesn't. The fourth difference: fast money players get carried away by noise. Time game players filter noise out. Fast money players' attention structure makes silence impossible. News, reports, charts, forums, group chats, any small piece of bad news can shake a perfectly stable thesis. The more their attention is occupied, the more their mind is disturbed. The more their mind is disturbed, the more unstable their actions become. Time game players care about only one thing: is the business still operating? Well, everything else falls outside their decision framework. This clarity is why they stay calm when noise is at its loudest. The more chaotic the market feels, the easier it becomes for them to see which companies continue to operate steadily. The fifth difference: the fast money game tests reaction speed, the time game tests emotional stability. The longer fast money players play, the more exhausted they become. The longer time game players play, the more relaxed they become. Not because their investments are fundamentally different, but because their psychological structures are. The fast money mindset is anxious, tense, and short-term. The time game mindset is calm, steady, and long-term. The same company, in different temperaments, becomes different destinies. Fast money players turn a good company into a chart of short-term volatility. Time game players turn the same company into a long-term cash flow engine. Whether you capture a tenfold return is rarely determined by the company. It's determined by you. The same company, different mindsets, different paths, different outcomes. This is the first great divergence between the fast money game and the time game in the trajectory of a person's life. If you watch anyone who stays in the fast money rhythm long enough, you'll notice a common pattern. The more they do, the more tired they become. The busier they get, the more anxious they feel. The harder they try, the more it feels like something invisible is pushing them forward. This exhaustion isn't physical. It's a constant psychological load, the pressure of checking prices, checking others, checking volatility, checking news. It's as if there's a switch in their mind that never turns off. And all of this looks like investing, but it's actually a form of depletion. The first kind of exhaustion in the fast money game is attention fatigue. In this game, you are not watching the market. The market is watching you. Every headline, every price tick, every good news or bad news alert pulls your attention away by force. You're compelled to react because not reacting feels like falling behind. Long-term tension in attention turns people into a tightly wound string that could snap at any moment. Over time, people develop a strange feeling toward investing. Doing nothing feels uncomfortable. Doing something feels regretful. A whole day passes with no real progress, yet they feel drained. The second form of exhaustion is emotional depletion. The market changes every day, and your emotions move with it. When prices rise, you fear selling too early. When they fall, you fear they'll fall further. When nothing happens, you fear missing out somewhere else. You spend every minute trying to manage your emotions, yet never succeed. In this cycle, the mind keeps burning energy, making people more sensitive, more impatient, more afraid of slowing down. After a few years in this state, a realization emerges. I'm not investing. I'm being dragged by prices. The third form of exhaustion is losing control of your life's rhythm. You'll notice it slowly. You can no longer focus on reading a book. During a meal, you keep glancing at the market. even on vacation, you can't fully relax. Your emotions are now tied to the market. Every tick of the price moves your mood. Your life rhythm has been outsourced to the market. That passive dependence creates a long-term silent anxiety. The time game offers a completely different experience. The first feeling of the time game is ease. You are no longer pulled by price movements because you're not focused on today. You don't need to stare at the screen because you hold a business, not volatility. You aren't forced into reaction. You choose your own actions. When short-term emotions stop pulling the strings, the mind naturally loosens. The second feeling of the time game is clarity. The clarity that appears when your pace becomes slower, when you no longer drain your attention on every headline, every chart, every opinion. You begin to see which companies truly endure through time and which are merely temporary noise. The deeper fast money players look, the more chaotic things appear. The deeper time game players look, the clearer things become. The third feeling of the time game is freedom. Not financial freedom, but psychological freedom. It comes from structural stability, knowing what you're doing, knowing why you're doing it, and knowing that future volatility won't push you off your path. You no longer rely on daily price movements to validate your decisions. Your sense of safety comes from understanding, not from the market's reactions. Your rhythm is set by choice, not by noise. This is the most valuable part of the time game. Not earning more, but living lighter. In the end, the essence of this chapter is simple. The longer you play the fast money game, the more exhausted you become. The longer you play the time game, the more stable you become. The fast money game ends in fatigue. The time game ends in freedom. The moment the time game truly changes your destiny is not when you buy a stock, but when you first realize you're not buying a stock at all. You're buying a business. Most people look at prices. A few look at businesses. The first group plays the market's game. The second group plays time's game. They live in two completely different worldviews. If you study the people who created extraordinary returns simply by holding, you'll notice something they all share. They never see themselves as traders. They see themselves as long-term partners of a company. That identity shift completely changes the way you view the market. The first layer of understanding, AA stock is a ticket, but a business is a structure. Most people look at stocks as numbers on a screen. Up means happy, down means worried. They judge whether a company is good based solely on the price trend. If it's rising, it must be good. If it's falling, it must be bad. This way of thinking ensures you will always follow prices and be dragged by short-term rhythm. Time game players see it differently. They know price is just an emotional projection, while a company's real value lies buried in a structure you cannot see. Structure determines destiny. Price is only the reflection. You must ask yourself, what exactly is this business? Why does it make money? How long can it keep making money? Can competitors replace it easily? Can it survive cycles? Is it lifted by temporary tailwinds or protected by a moat it built itself? These questions create long-term returns. Short-term price movements don't. The second layer of understanding, the essence of a business is cash flow, not stories. The easiest thing in the market to be fooled by is a good story. Stories about industries, stories about management, stories analysts love to tell. But stories don't feed a company. Cash flow does. To judge whether a business can survive time, you only need to look at three things. First, does it generate steady, predictable cash flow? Second, do customers depend on it? Are they truly attached? Third, is the product or service deeply embedded in daily life in a way that's hard to remove? If a business's cash flow breathes like a steady heartbeat, it already has the foundation to outlast cycles. A story may keep a company hot for 3 years. Cash flow keeps it alive for 30. Time game players don't pay for stories. They pay for structures that continually produce cash. The third layer of understanding: only businesses that time cannot destroy deserve to be played with time. Every industry has its boom and its winter. Every company has peaks and troughs. Only those businesses that can absorb time's pressure, market chaos, and cyclical shocks are truly suited for the time game. Such businesses usually share three traits. First, they sell habits, not hype. Habits are far more reliable than trends. You might skip a restaurant today, but you won't stop drinking, stop paying for essentials, stop using core services. Habit is an invisible contract. As long as the habit remains, the business does not break. Second, their business has repetition and stickiness. People use the product over and over again, not once, but repeatedly and long term. The more frequent the behavior, the harder it is to change. Once a business becomes part of someone's routine, its moat widens naturally. Third, they can operate as usual during adversity. This is the ultimate test of whether a company can survive time, when markets are chaotic or cycles turn hostile. True quality companies maintain two things: customers and cash flow. Headlines, news, and prices are noise. What breathes through a storm is the essence. The fourth layer of understanding: you look at businesses with logic. You look at prices with emotion. The more you depend on price, the more you depend on feeling. And the more you depend on feeling, the less likely you are to play the time game. The time game requires a stable logical structure. How does the company earn? Why can't customers leave? Will this model still stand 10 years from now? Can rivals easily replace it? Does this business allow time to become an ally? The answers to these questions are your foundation. If the logic holds, your position holds. If the logic holds, your emotions hold. The fifth layer of understanding: price is easy to understand. Busyness is hard to understand. But difficult things create moats. Most market fluctuations are short-term emotion. Emotion-driven prices are easy for everyone to interpret. And the more people can interpret something, the less value it has. Long-term value hides in things you must slow down to grasp. Understanding structure, understanding durability, understanding what survives time. These things cannot be understood quickly and cannot be erased by short-term fear. The fewer people understand them, the longer they endure. The core of the time game is identifying these things and then letting time prove you right. A business is a tree. Price is a leaf. The market stares at leaves changing color. Time cares only about roots growing deep. Real returns belong to the companies whose roots survive seasons. In the market, nothing reveals the difference between the two types of players more clearly than panic. Panic is the ultimate disaster for fast-gen money players, but it is natural fertilizer for time-gen game players. Most people lose direction when panic appears. A few stabilize their rhythm, They're looking at the same price, yet living in two entirely different worlds. Why? Because panic doesn't test skill, prediction, or intelligence. It tests something far deeper, the underlying game you believe you're playing. Time-gen game players are not afraid of panic for 5 fundamental reasons. The first reason, they don't treat price as reality. To fast-gen money players, price is reality. Where the price goes, their emotions follow. Their mental state rises and falls with every tick. They think, it's dropping. This is bad. It's collapsing. I need to run. Is this the end? Emotion dances with the movement of price. Time-gen game players see something else entirely. They don't ask, what is the price doing? They ask, has the business changed? If customers are still using the product, cash flow is still flowing, operations are still functioning, and competitive position remains intact, then what fell was the price, not the reality. Reality lives in the business, not in the chart. During panic, time-gen game players look at a company's actual operating condition, while fast-gen money players look at the red numbers on the screen. Different attention leads to different interpretations of fear. The second reason, they know panic cannot destroy a good business. Panic can crush prices, but it cannot crush a business that is rooted in real demand. A company's destiny depends on 3 things. Are customers still using it? Is the business still running? Is cash still coming in? None of these depend on market emotions. None depend on today's stock price. A good company doesn't stop making money because people are scared. Its product doesn't disappear because sentiment collapses. Its customers don't walk away because the index is down. Time-gen game players understand a simple truth that most people forget. Panic destroys the bubbles around value, not the value itself. The third reason, they know panic is when value and price finally separate. When markets are calm, value and price sit close together. It's hard to find bargains. Everything looks reasonably priced. Only during panic does emotion distort price enough to create a meaningful gap. That gap is the opportunity zone for time-gen game players. The bigger the emotional swing, the bigger the gap. The bigger the gap, the greater the long-gen-term return. Not because panic has magic, but because extreme emotion pushes price away from real value. The larger the deviation, the stronger and faster the recovery, and the richer the future payoff. The fourth reason, their confidence comes from understanding the business, not guessing market reactions. Fast-gen money players ask during panic, is this time different? How far will it fall? Is everyone selling? Should I run too? Their fear is the unknown. Time-gen game players ask, is this company in danger? Are the customers still there? Is the product still irreplaceable? Can the cash flow carry it through? Their concern is the business, not the market. One relies on emotion, the other relies on logic. Panic is an emotional pressure cooker. Emotion-gen-based decision makers fall apart. Logic-gen-based decision makers often see more clearly than usual what is stable and what is fragile. The fifth reason, they know panic doesn't require brilliance. It requires not doing something stupid. Most people make mistakes during panic not because they misjudge, but because their emotions take over. They know the company is fine, but they run because others are running. They know short-gen-term volatility doesn't define long-gen-term destiny, but they sell at the bottom because they fear losing more. Panic's real damage comes from making people trade long. Jan term wisdom for short, Jan term reflex. Time Gen game players have an advantage. They never treat panic as a moment where they must perform. They don't rush to catch bottoms. They don't rush to escape. Their first step is always the same: verify the truth of the business. If the business is intact, cash flow stable, customers unchanged, core unbroken, then panic can only do one thing: make the price cheaper for a while. If the business has real structural damage, then it wasn't worth holding even during good times, let alone during panic. The logic isn't complicated, but almost no one can hold on to it during fear, because everything in the fast Gen money game amplifies panic, while everything in the time game stabilizes judgment. Why are time Gen game players unafraid of panic? It can be summarized in one line: panic is a nightmare for fast Gen money players, but clear skies for time Gen game players. The more intense the panic, the more willingly time stands beside those who understand it. In the world of investing, many people assume the outcome depends on intelligence, on analytical skill, foresight, or predictive accuracy. These things exist, of course, but in the time game, they do not determine your destiny. What truly decides the outcome of the time game is temperament. Intelligence determines whether you understand the rules. Temperament determines whether you can follow them. Most people understand long Jan term thinking, yet they still can't practice it, not because they lack intelligence, but because they lack stability. Temperament is the real threshold, and the time game is difficult precisely because it challenges the most unstable part of human nature. The first test, the ability to endure no feedback, the most powerful, but also the most painful aspect of the time game, is that it provides almost no immediate feedback. Short Gen term trading gives instant reactions. If it rises, you feel right. If it falls, you feel wrong. This is the poison of the fast Gen money game. It feeds your dopamine with instant results. The time game doesn't do this. Its trajectory looks like a silent curve. You might hold something for a year or two and see almost no visible change. It doesn't reward you in moments. It rewards you years later, when you suddenly realize that patience was the strongest force all along. There's an old saying in the East: clarity arises from stillness. And the hardest part of long Jan term investing is whether you can stay clear Jan-headed through that long, silent stretch, without rushing, without anxiety, and without doubting yourself. This long period of silence makes most people give up, not because they don't understand, but because they can't wait. The second test, the ability to endure others getting rich faster than you. The time game focuses on 10 years. The market focuses on today, tomorrow. Next week, this creates a psychologically destructive experience. Others double their money in 3 months. You see nothing in 3 months. Others show off returns. Your investment is still flat. Comparison triggers impatience. Impatience pulls you off the right path. The desire to catch up drags you back into the fast Jan money game. The time game has never been a game for short Jan term winners. It belongs to those who can watch others sprint ahead temporarily and remain unshaken on their own path. The third test, the ability to accept imperfection. Long Jan term holding means facing endless uncertainties, short Jan term drops, industry noise, policy swings, quarterly fluctuations. You must accept that. Great companies don't rise every month. Strong businesses sometimes report weak quarters. Industries have headwinds. Environments shift abruptly. The time game is not about perfection, but about durability. You don't need a company that never makes mistakes. You need one that mistakes cannot break. Strong temperament sees continuity beyond the noise. Weak temperament gets pushed around by every temporary imperfection. The fourth test, the ability to endure boredom. The time game isn't exciting. It has few actions, few dramatic moments, few new decisions, little constant change. In fact, it feels slow, dull, and deeply counterintuitive. This is why most people lose to time. They don't lose to the market. They lose to boredom. Boredom creates the urge to act. Action breaks the long Jan-term structure. Once broken, you restart, and each restart resets compounding. Masters understand something simple. Great long Jan-term outcomes emerge from days that look like nothing is happening. Compounding doesn't grow during dramatic moments. It grows quietly through countless ordinary days. The fifth test, the ability to endure your own emotions. The true enemy of the time game is not the market, it is yourself. Fear, anxiety, pride, restlessness, doubt, herd instinct. These internal forces derail long Jan-term behavior. You should stay calm, but you can't. You should be patient, but you break. You should think long, Jan-term, but short Jan-term noise pulls you around. This isn't an intelligence problem. It's an emotional structure problem. Strong temperament doesn't mean lack of emotion. It means not letting emotion dictate action. It's not coldness. It's clarity. People with weak temperament are not incapable of long Jan-term investing. It's just that the long Jan-term path feels too noisy, too slow, too uncertain for them. The sixth test, the ability to endure the silence of time. The time game follows a brutal truth. Time stays silent for a very long time, and then suddenly rewards those who endured the silence. The silence can last so long that most people assume they're wrong, long enough to make you doubt your own judgment, long enough to make others seem far ahead of you. But time never rewards those who rush. It rewards those who can withstand its silence. The greatest long Jan-term returns are always born quietly. In the end, the time game tests not intelligence, but temperament. Intelligence helps you understand the rules. Temperament allows you to win with them. Only when your temperament is steady can you truly stand on the side of time. And once you stand on time's side, time becomes the most loyal ally of your life. In the market, people argue endlessly about methods. Growth versus value, cycles versus trends, active versus passive, offense versus defense. But behind all these debates lies a deeper question that almost no one truly asks: what game am I actually playing? The fast Jan money game, where price pulls you like a leash, or the time game, where you work alongside time itself? This is not a matter of style. It is not a matter of technique. It is a fork in the road that splits Rinsun into two completely different trajectories. The fast Jan money game gives you speed, excitement, and bursts of short Jan-term adrenaline. But it also brings exhaustion, anxiety, constant action, constant reaction. It makes you more sensitive day by day, yet more confused year by year. The time game looks slow. It looks boring. It looks not clever enough. But it brings stability, continuity, and structural clarity. The longer you walk it, the steadier you become. The longer you stay, the lighter life feels. The longer the horizon, the more freedom you gain. Fast versus slow is not a matter of right or wrong. but their destinations are nothing alike. If you choose speed, you must bear the cost of speed. If you choose time, you must accept the rhythm of time. In the end, the market does not reward effort. The market does not reward intelligence. The market does not reward courage. The market only rewards the people who stand inside the right game. In this episode, we discuss rules, structures, temperament, and the long term. But all of these begin with a single question. Are you willing to pull yourself out of the fast and money game? Are you willing to slow down? Are you willing to let time stand on your side? Time will not invite you. Time will not remind you. Time will not approach you on its own. Time rewards only those who switch games first. There's an old saying in the East, steady steps carry you far. Investing works the same way. You stay steady before you go far, and you choose right before you go long. So, are you ready? Ready to shift from reacting to choosing, from chasing to understanding, from passive to active, from the fast gen money game to the time game. Because only when you choose the right game can time truly begin to work for you.